Hey guys, how's it going? Every investor knows that the US government debt is the most secure investment in the world. It is so secure in fact that most investors use it as a substitute for a risk-free yield when calculating the value of companies. But did you know that there are two American companies that have a higher credit rating than the American government? These companies are doing so well that credit rating agencies see them as safer than the safest government debt. Even better, both companies are great dividend growth stocks. In this video, we are going to look at whether these are two dividend stocks to buy now. But before we go into that, let's take a look at what credit ratings actually are and why we should care. So, what is a credit rating? In a nutshell, it is how credit rating agencies such as S&P, Moody's, and Fitch assess the ability of an entity to pay back its debt. These ratings go from AAA being the highest to CCC or D being the lowest. What they signify is the likelihood that the entity will go bankrupt. With AAA bonds, you have about a 0 to 0.2% chance of default, which goes up to 26.6% with C-rated bonds. Back in the 90s, we had 60 different companies rated AAA, but now we have only 2. Great, that's amazing information, but so what? Why should we care? A few reasons, but the main one is that a lower credit rating equals higher cost of debt. The average AAA debt typically has the smallest spread over the 10-year US Treasury yields. Currently, this is 0.98%. In comparison, the average BBB debt currently has a premium of 2.1%. If we look at debts with a rating of C, that premium will be much higher. This has a massive impact on businesses as it increases the amount of interest they are going to pay. If a company relies a lot on raising money through debt, this is a very important metric to follow. One example is REITs, which tend to rely on debt to buy new real estate. High borrowing costs also limit the amount of viable projects for a company. If a company starts working on a new project which will give them an estimated 5% return on investment, issuing new debt with an interest rate of 6% is obviously going to lose them money. However, if they can issue that debt at a 4% interest rate, then they will be making a profit on that investment. This is a very simple example, but I hope you get the idea. So, which are the two stocks with a better credit rating than the US government? Johnson & Johnson and Microsoft. Currently, S&P has given the US government a AA rating with a stable outlook. In comparison, both Moody's and S&P have given Johnson & Johnson a AAA rating with a negative outlook, and Microsoft a AAA rating with a stable outlook. If we have to be completely transparent, Moody's has also given the US government a AAA rating with a stable outlook, so there is a small discrepancy there. Still, we can see that both Johnson & Johnson and Microsoft have rock-solid financials. I personally like Microsoft more, but let's take a quick look at Johnson & Johnson. They are one of the biggest pharmaceutical and healthcare companies in the world, with a stock ticker of JNJ. Johnson & Johnson sell everything from baby oil to medication for arthritis, diabetes, even cancer. One of the reasons why their credit rating is so high is the global demand for their products. Johnson & Johnson is a household name. Their products are established and they are consistently growing. For Q1 of 2023, Johnson & Johnson made $24.75 billion with an EPS of $2.68. This represented a 5.63% increase in revenue as compared to last year, although their earnings only increased by 1 cent. Johnson & Johnson also increased their EPS outlook to between $10.6 and $10.7 for the 2023 financial year, up from $10.45 and $10.65 previously. They also upped their revenue guidance to $97.9 and $98.9 billion, compared to prior outlook of $96.9 and $97.9 billion. From what we can see, Johnson & Johnson are doing great as a business. In terms of financials, the company has a long-term debt of $34.9 billion plus short-term borrowings of $18 billion on a cash position of $26.6 billion. Despite this, Johnson & Johnson is actually making money on its interest. In the last 12 months, the company made a net $222 million of interest income. This is why credit rating is so important, guys. Not only do Johnson & Johnson keep their expenses low because of their credit rating, they actually make extra money because of it. The company is also repurchasing shares again and has reduced its outstanding shares by about 1.2% in the last 12 months. It's not a lot, but it is a step in the right direction. The dividend yield for Johnson & Johnson is good at 3.08% with a 5-year dividend growth rate of 6.02%, plus 60 years of consecutive dividend raises. It is probably one of the safest dividend growth picks on the market. The current expectation is a 5.6% dividend increase in the next year and a 3.1% annualized dividend growth rate over the next 3 years. As a whole, Johnson & Johnson look really good on paper, but there are a couple of question marks. The main one right now is the recent spin-off of the consumer health unit, which brought in $3.85 billion in Q1. That unit is now a separate stock called Kenvue Incorporated, trading under KVUE. It was not the biggest part of Johnson & Johnson. The management wants to focus more on the other segments, so maybe this spin-off made sense. The idea here is that we should get a more efficient, more streamlined company as a result, but this is still a massive restructuring, which always introduces a lot of risk. I'm sure we are going to see the effect of the spin-off over the next few quarters, so it's important to keep an eye on how the stock and the business perform. Currently, the valuation is not that pricey, with an adjusted forward PE ratio of 14.5 or GAAP PE ratio of 21.3, both of which are below the sector median. The expected earnings growth of 4.4% in the next few years gives us an adjusted PEG ratio of 3.3. However, this does not consider the dividend yield, so I will take a look at the PEG-Y ratio, which Peter Lynch used to assess dividend companies. If we include that, we get an adjusted PEG-Y ratio of 1.95 or a GAAP PEG-Y ratio of 2.9. Both of these are expensive, but I have to say that as one of the safest companies in the world, Johnson & Johnson will come with a pricing premium. The company is trading for $154, which is close to its pre-pandemic peak, down about 16% from its all-time high of $184. I personally think that the current price is great for opening a new position, and I will be looking to get some of this solid dividend stock in the next couple of weeks. Now, time to look at Microsoft, stock ticker MSFT. Microsoft is the second biggest company in the world by market cap, just after Apple. Pretty much everyone is familiar with Microsoft, Bill Gates, Paul Allen, Windows. Microsoft is an established tech company with solid revenue streams from products like their Windows operating system, their Microsoft Office Productivity Suite, LinkedIn, Xbox, Azure, Bing. Microsoft owns 50% of OpenAI too, and is basically a leader in cloud, AI, operating systems, gaming platforms, and more. The company has stood the test of time. It has continued to reinvent itself and continued to expand. I find it hard to say anything negative about the company's operations because they do run a very tight ship. There is a reason why their credit rating is better than the rating of the US government. Microsoft is one of the most solid companies on the market. In Q3 of 2023, Microsoft made $52.86 billion in revenue and had an EPS of $2.45, beating expectations by $0.22. Microsoft's revenue went up by 7.1% as compared to last year, and their earnings went up by 10.4% from $2.22. There is a reason why Microsoft makes for a great dividend growth stock. The company keeps growing its earnings every year. Despite being only 0.82%, the dividend also grows every single year, with a 5-year growth rate of 10% and 18 consecutive years of dividend raises. The tech stock's financials are rock solid, with a long-term debt of $42 billion on a cash position of $104.4 billion. The only problem with stocks as good as these is the fact that they are typically very expensive. That's my main issue with Microsoft right now. The valuation is high, with a forward PE ratio of 35 relative to the IT sector's median of 24.1. Their PEG ratio is 2.9. Even when we look at the PEG-Y ratio for dividend stocks, that's still 2.74. Microsoft is trading close to its all-time high with a current price of $332.9 and a market cap of $2.48 trillion. What does this mean for you and me? It means that the margin of safety is small and the risk-reward ratio is not that great. For the last year, I've been buying a bit of Microsoft every week, but I plan to stop this for a bit since the price is pretty high. I'm actually thinking about taking some profits, and the moment Microsoft drops below $300, I will resume my weekly purchases. What do you think? Are you bullish on Johnson & Johnson? What about Microsoft? Let me know in the comments below. If you find this research useful, please leave a like and share the video, and I will see you again in the next one.